Welcome back, real estate family. Let's take care of some admin business. First, I need you guys to subscribe and turn on those notifications. When I drop some knowledge, you will be notified. Let's take care of that, and then we go dive into it. All right, we're back. Now that you're subscribed and you put that notification on, let's dive into this. The 3 C's to buy a home. First one we're going to hit on is character. Character is big with the banks. If your credit score is low, if you don't even know how much money you're making on a regular basis, not that you have a good job now, but how long have you been in that good job? That's what the banks want to know. So let's talk about it a little bit. Your character reveals who you are, your credit identity, your credit history. Have you previously managed your bills on time? Or do you have a history of paying your bills late? Banks do not like late payments, although they make a lot of money off of you guys who are late on your payments because there's something that's called interest. So let's pay our bills on time, and let's have a reality check on our credit worthiness if we are trying to get a loan from the bank to buy a home. The credit range from 350, which is the very bottom, all the way up to the excellent credit range of 850. Now I'm going to talk about it later, how you could buy a home using an FHA loan at 500 credit score. Also take note, there's a big difference of your lending score and your personal score. So if you look on Credit Karma or your banks, those are your personal score, not your lending scores. Step 2 of the 3 C's to buy a home, capacity. We have to know our income. We have to be realistic. Your income is going to tell you how much home you can afford. And then we're going to dive into the debt income ratio. Debt income ratio is how much debt you have combined with your income. Now let's do a quick calculation for this. It's going to be very easy. If you need to get a notepad, let's get a notepad, pen and paper, or on your phone in the notes. So this is what we're going to do for this one to determine your debt income ratio. So say you have a home, well, just say our income, we make $12,000 a month, right? So write $12,000 a month, and then what we're gonna do next, what's your proposed house payment? We're in Southern California, so let's take the average. Let's say about $5,000 a month. Plus your car payment, say about $400, and then we have credit card bills, say $200 now. That's going to equal our debt to income ratio. But how can we get the equation on that, right? So the numbers I just gave you, we're going to add our proposed house payment, $5,000, our $400 car payment, and we're going to add our $200 credit card payment, our minimum credit card payment, not your balance, just the minimum monthly payment. So when we add those numbers up, we're going to get about 46% DTI. Again, how we do it, say we made $12,000 income, right? And then we go calculate our expenses. We got $5,000 for our mortgage payment, $400 monthly for our car payment, and $200 monthly payment for credit cards. We're going to divide that number by our monthly income, gross income, which is $12,000. That's going to give us the 46% debt to income ratio. That's our capacity to buy a home. Now, also to mention, capacity is not just your income, it's everyone who's going to be on that loan. And the income could be from alimony, child support. If you're a veteran, you have VA benefits, your disability benefits, your Social Security, any commission you may have coming in, any interest income from rental properties, or any investment income. All that can be calculated into this capacity zone. And our last and final is collateral. That's the 3rd C of the 3 C's to buy a home. Self-explanatory. What is collateral? It's your property. The banks want to feel secure when they give you a loan. So basically, it could be a lien on your property until you pay off that note. That's the leverage that the banks are going to have with you. They're going to say, hey, John, we could give you this property at X amount of dollars, but we're going to hold it as collateral until you finally pay off your mortgage. Let's give an example. Example would be, say it's a security or guarantee from the borrower that can be foreclosed on if the loan is not paid back or not paid back in a timely manner. Remember I was telling you in the beginning, going back to character, your credit history, your credit worthiness. Banks want to see on-time payments. Okay, real estate gang, those are the 3 C's to buy a home. I want you guys to share this with a friend, a family member, or anyone who may just be thinking about buying a home. Also, don't forget, I'm on Instagram at Real Estate with Regan. Please put on those notifications, because sometimes during the week I may drop some more golden nuggets here and there. I may go to a football, basketball arena, stadium near you. So I'm out. Peace. See you soon.